So all bank liability will be issued what were given by federal funds. Which are the instruments are? One is equity share, debenture, bonds and corporate deposit, mutual fund and government security. When the company liquidates, first we pay to the preference shareholder their dividend. If any amount is left over, that goes to equity shareholder. Hello my dear students, I am Dr. B.S. Subramaniam, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram, First Aid College, a Temple of Excellence, MYSURU. I am going to hand Security Analysis and Portfolio Management, 6th semester, Unit 1, Session 2 in favor of BBA. This is Introduction to Investment, first unit we are doing. Yesterday we saw I have explained in the last session about the investment. Today I am going to explain the capital market. Capital and money market. It is a market for borrowing and lending of long-term finance. Borrowing and lending of long-term finance for a period more than 1 year, long-term. It is an organized financial market where saving and investment is channeled between the one who has sufficient money and one who is in need of money. So whatever this says, no, we have got such certain money, somebody wants it, somebody wants to invest it here. The man who wants to invest will give to the needy, the man who are in need of money. This is a sentence. Who has sufficient money with them and one who is in need of money. Instruments of capital market. Which are the instruments are? One is equity share, debenture, bonds and corporate deposit, mutual fund and government security. They are called the instrumental of capital market. How the capital market flows in a different division. One on equity share, one on debenture, one on mutual fund, one on government securities. So we'll go one by one. Equity share. It is regarded as the cornerstone of the capital structure of a company. There are two types of share. One is called equity share, another is called the preference share. Equity shareholders are permanent shareholder, whereas preference shareholders are temporary shareholder. The major source are equity share, we always say this word. They are the source of permanent capital which does not have maturity date. So the two types of capital I told you, one is equity share capital, another is preference share capital. Preference share capital, they are going to remain maybe 3 years, 4 years and 5 years maybe. So their preference share capital will be redeemed with a dividend, whereas equity share capital money will not be paid back till the lifetime, till the company liquidate. When the company liquidate, first we pay to the preference shareholder their dividend. If any amount is left over, that goes to equity shareholder. So the permanent shareholders are equity shareholder, not preference shareholder. So which are the two types of share? One is the preference share, one is the equity share. Equity shareholders are permanent shareholder. Preference shareholders are temporary shareholder. Their money will be paid back after a stipulated time, maybe 3 years, maybe 5 years. Whereas equity share capital will not be paid back till the lifetime. Their money will be paid back only when the company liquidate. They are the source of permanent capital which does not have maturity date. As the owner of the equity share, the equity shareholder can participate in management of the company. They can participate in the management of it not by preference shareholder, through elected board of directors, through the voting rights in the important decision. They share the profit and assets on proportion to their holding in the net asset of the company. When the profit comes, out of the profit, first we pay the outsider, any expenditure is there, that expenditure will be paid. whatever the amount left over, first we'll pay to the preference shareholder. Any amount left over that goes to equity shareholder. That profit divided by number of shareholder is called dividend. Then they have the voting right. Preference shareholder has no voting right. Equity shareholder can participate in the board of direction, company's elected board of directors, and through the voting right in important decision making. So who can participate? Only equity shareholder, not the preference shareholder. They share the profit and assets on proportion of their holding. Whatever they're holding, they will get their profit in the net asset of the company. Net asset means total asset minus total liability, capital employed, minus preference share capital, whatever left over, that is called the net asset of the company. Instrument of capital market. Number 2, preference share. First is equity share, next is preference share. Preference shares are those which carry a preferential right to payment of dividend and carry a preferential right to repayment of capital in the event of winding up the company. When the company wind up, first we have to pay to preference share capital their dividend. If any amount left over, that goes in the favor of equity share capital. So they will get the rate. The rate of dividend is fixed. Always we say like this word, 6% preference share capital. You mean to say that preference share capital gets 6% rate of dividend. Rate of dividend is already prefixed. Regarding the equity share, dividend is not fixed. Whatever left over divided by number of shareholders. What is actually dividend? No, total profit of the company minus expenditure minus preference share capital, their dividend divided by number of equity share, the dividend of the equity shareholder. Regarding the percentage is fixed on their what profit is covered. What do you mean by 6%? That is the rate of dividend. Preference shares are those which carry a preferential right to payment of dividend and carry a preferential right to repayment of capital in the event of winding up of the company. Winding up means closing of the company. Debenture. It is an instrument under seal, evidence of debt. It is evidence of debt. The essence of debenture is admission of indebtedness. It is a debt instrument issued by a company with a promise to pay the interest and repay the principal on maturity. So one company will borrow the money from another company is called debenture. Debenture will be paid with interest. It is a debt instrument issued by a company with a promise to pay interest. Promise to pay interest and repay the principal on maturity. Principal plus interest. Debenture holders are secured creditors. Some security will be given by the creditor to get the loan of the company. In the event of liquidation, preference will be given to debenture holder before the preference and equity share. When the company liquidate, we have got a certain format before the preference shareholder, before the equity shareholder. First, we have to pay the debenture because they are the secured creditor. Debenture, their interest, then preference shareholder, their dividend. If anything amount left over, that goes to equity shareholder. We have a certain format in the liquidation while you're making the payment now. First, we have to pay the debenture holder, their interest, then preference share capital, their dividend. If anything left over, that goes to equity shareholders. Then bonds. The bonds are debt instruments that are issued by companies or government to raise fund for financial their capital. So bonds are nothing but one type of debt instrument that are issued by the company or government to raise the fund for the financing their capital. By purchasing a bond, an investor lends money for a fixed period of time at a predetermined interest rate. Bonds have a fixed face value, which is the amount to be returned to the investor upon maturity of the bond. So when the maturity comes, no, we write on the bond about 6 lakh plus. They will write interest we have to pay back. So bond when they mature, no, we have to pay back on maturity of the bond. Government securities. The securities issued by state or central government are termed as government securities, nothing but share. They may be issued in the following form: a promissory note payable to or to the order of a certain person. It's a promissory note can be given as a debt. A bearer bond payable to bearer, a stock, a share, a bond held in a bond legally. They have safe and security investment in them with regular return. These are guaranteed by the government. Government security can be issued by the central or state government or both. This is nothing but one more debt security given by the government. Money market. The money market refers to trading in very short-term debt investment. As per RBI, Reserve Bank of India, the term money market is used to define a market where short-term financial assets with a maturity of up to 1 year are traded. Here there is a difference. Capital market has a long term, whereas a money market is a short term of 1 year. Instrument of money market: treasury bill, commercial paper, banker's acceptance, deposit, certificate of deposit, bills of exchange, repurchase agreement, federal funds. These are all the things you have to bear in mind. Go with one by one. Treasury bills. The federal government raise cash by issuing the treasury bill. Some bills will be given by the government. Their maturity will be 1 year or less. So the bills will be matured after, and the maximum will give only 1 year or less than 1 year. Commercial paper. Large companies with impeccable credit can simply issue short-term unsecured promissory note to raise cash. Asset-backed commercial paper is a derivative based on commercial paper. Commercial paper is one of the debt. It has been issued for a period of 12 months only. So money will be paid back after 12 months. Then banker acceptance. This work as a bank token for international trade. The bank guarantees that the buyer will pay for goods received typically 30 to 60 days later. An importer wants to make goods, but exporter wants to give him a credit. He goes to his bank, which guarantees the payment. The bank is accepting the letter of payment, responsibility for the payment. So there are two parties in a business. One is the exporter, one is the importer. The importer will take the goods from the exporter. The exporter wants some security. So the importer says, I will give the security of my bank. My bank is responsible to pay your money. This is the word. For international trade, this is only goes in the international trade. The bank guarantees that the buyer will pay for goods received typically 30 to 60 days on behalf of the trader. Who gives the guarantee? The banker will give the guarantee. Your money will be paid back with a period of 30 to 60 days. An importer wants to make goods, but exporter won't give him credit. He does not want to give the credit. Then what the importer will do? He goes to his bank, which guarantees the payment. He says, I will guarantee on behalf of the importer. The exporter say, I won't give the credit to you because there is no guarantee from you. Then the importer says, I have got my own bank. The bank will give the guarantee on behalf of me so that we can give the credit. Then the exporter will approach the importer banker. If the banker accepts as a guarantee on behalf of the importer, then only they will sanction the loan. The bank is accepting the letter of payment, responsibility for the payment. Who is responsible? The banker is responsible to pay the exporter. This goes in the favor of international trade. Then certificate of deposit. Banks issue certificate of deposit by depositing to raise short-term cash, duration from 1 to 6 months. The certificate deposit pay the holder higher interest rate the longer the cash held. So here banker will have a certificate of deposit. We can what called in a bank, no, we can deposit the money. The banker will issue a deposit. The deposit money will be paid back with a higher rate of interest. Federal funds. Banks are the only business that use federal funds. Bank use them to meet the Federal Reserve requirement each night. It is roughly 10% of all bank liability. So all bank liability will be issued what were given by federal funds. Repurchase agreement. If or when a bank issues security but promise at the same time to repurchase them later at a valued high price. So banker give the what's called guarantee, will take back with a high price. Bills of exchange, also called draft or short-term negotiable financial instrument, consisting of an order in writing addressed by one person, the seller or a drawer, to another, the buyer, requiring later to pay on demand or at a fixed future time a certain sum of money actually to a specified person. There are two parties are there. One is called the drawer. Another party is called drawee. Drawer is one. Here, drawer is nothing but a person who is selling the what's called financial. One person called seller. Drawer is the seller. Drawee is the purchaser. When a drawer, the drawee will give a what's called, will ask another person, a buyer, requiring the later to pay. So drawer writes a bills of exchange saying that the drawee has to pay the money. They may have a demand for the money. They will have a bill has been exchanged between the drawee. Who writes that? Drawer will write on drawee. Drawee has to pay the money after certain time. Another buyer requiring to later to pay on demand or at a future time. It may be 6 months, it may be 1 year. Either he has to pay on the future, that particular date, future time, or on demand at a certain sum of money specified in the bills of exchange. In the bills of exchange, it has been specified by the drawer. When a purchaser take the goods from the drawer seller, drawee says, I will pay your money after 6 months. You give a letter. Who writes the letter? Drawer writes the letter on drawee saying that you have taken the goods on credit. You have to pay back the money after 6 months with the interest. If it does not pay the money, then we'll go to a court of law. So who writes? Drawer writes on the drawee. Drawer is seller, drawee is the purchaser. Either he has to pay on demand or a fixed future time at a certain sum of money specified in the bills of exchange. Deposits. Money market deposits are a type of saving account. Deposits are a very safe investment, though are generally used for short-term than a long-term investment. Flexibility and liquidity set deposit apart from several types of common interest bearing saving before money factor for choosing them. Here, flexibility is there and liquidity has been set deposit apart from several types of common interest bearing saving before money factors for choosing them. Here, this is important. These are all the money market instrument. So I covered capital market. I covered money market also. One question definitely comes, either money market or capital market. What are the instruments? This is important. They will say, what are the instrument of money market? This first you write in exam this point, you explain lightly all these point one by one. Whatever the explanation is given, you copy all these things now. Definitely it will help you from the examination point of view. Hope you understand. I have covered capital market and the money market. What are the instrumental of money market? What are the instrumental of capital market? Both I have dealt very slowly and very easy. You take the point and explain one by one. Hope in the last session I explained about the investment. In this session, I have explained money market also, capital market also. So these are the 315 marks question. They may ask capital market, they may ask money market, sometimes they may ask the investment or the other steps to be followed for the sake of investment they may ask. Yesterday we have a reference of investment 15 point I have explained. Today I have explained the money market also, capital market also. In the next period onwards, we'll have risk and return problems. Till then, goodbye. Meet in the next session.